Welcome to Sweet Speak. AI is reshaping the future of insurance and financial services, revolutionizing underwriting, transforming fraud detection, and redefining customer experiences. As we head into this year, financial leaders are navigating both incredible opportunities and new challenges in this AI-driven era. Today, we're diving into the game-changing role of AI in the industry, exploring its impact on risk modeling, cybersecurity, compliance, and the future of financial services. I'm excited to be joined by Mitch Wein, Executive Principal at Datos Insights. Mitch and I sat down for a recent LinkedIn Live Sweet Speak, dove into this and so much more, so you don't want to miss this. After the break, I'll be joined by Mitch. Welcome to Sweet Speak. Today, we're going to dive into the game-changing role of AI in insurance and financial services. Joining me is Mitch Wein, Executive Principal at Datos Insights, a recognized leader in technology strategy, AI-driven innovation, and digital transformation. With over 30 years of experience, Mitch has held executive roles at Bankers Trust, Prudential Financial, AIG, AXA, driving technology strategy, architecture, operational excellence across global financial institutions. Now, Datos Insights, there he advises senior executives on leveraging AI and emerging technologies to stay ahead in a rapidly evolving industry. So today, we're going to explore how AI is reshaping underwriting, fraud detection, risk modeling, and customer experience, and so much more, plus the biggest challenges and opportunities facing financial leaders this year and beyond. So let's dive in. First of all, Mitch, it's been a while since I've seen you. Great to have you on the show.
Great to see you, JD, and thanks for inviting me.
So I want to dive in first. AI is evolving rapidly. So what are the biggest ways it's transforming insurance and financial services this year?
Well, it's playing a big role. Firstly, it's gone from being an optional enhancement to an essential business capability. 90% of insurers are expecting major operational impacts this year in 2025, and 70% of all new carrier systems are being built on API-first principles, leveraging AI. We see carriers driving AI automation in underwriting, claims, customer service. Some statistics, 35% of life and annuity insurers are actively using large language models in production today, February 2025. 41% are in pilot programs. So we've moved beyond POCs into full production. We see the deployment of agentic AI really just starting this year, which really is autonomous decision-making capabilities, leveraging large language models on the back end to execute complex tasks. It's like macros on steroids, basically, in all financial services, commercial banking, credit assessment, treasury operations, underwriting claims, etc. And we see data processing generally being deployed in a number of other operational areas. For example, document management systems where 1,000 pages per minute with 90% accuracy can be done through for intake, and reducing processing time by 80% over traditional intake mechanisms. So again, huge impact. So
which AI-driven innovations do you think are proving to be the most disruptive for traditional insurance and banking models?
Mm-hmm. It's a couple of areas specifically. So underwriting is one. We see that AI-powered underwriting are processing applications 5 times faster than traditional methods and incorporating diverse data sources, external data sources, not just internal, for things like property details, environmental conditions, weather, etc. On the claims side, we see AI-driven damage assessment, and 60%, interesting statistic, of simple property claims are now being handled without human intervention across the insurance industry in the United States. We see, self-driving AI agents transforming advisor workflows. Very, very important for financial advisors selling life products, worksite, voluntary products, etc. And really what this is doing is for those products and really wealth management generally in financial services, democratizing these services, allowing clients to get the types of servicing options that only the high net worth and ultra ultra high net worth people got in the past. So really bringing more capability to more people with lower service delivery costs. And then we see real-time risk assessment, leveraging things like IoT devices, telematics, allowing for real-time policy adjustments and proactive risk mitigation strategies, including loss control strategies on the claim side.
Yeah, covered underwriting and claims. I want to dive a little more into that risk modeling because it's becoming more sophisticated, as you mentioned. How are insurers leveraging predictive analytics to stay ahead?
Yeah, there's a couple of things. One of the things to think about with predictive analytics is stochastic modeling and how many scenarios you can run. And can you ingest multiple scenarios and then recursively analyze over and over again? And what we believe is that if we think about moving forward, not just today, but into 2030, 2035, and even as far as 2040, we think that the combination of AI with quantum, so QAI, will revolutionize risk modeling. We expect that over 90% of risk modeling will be leveraging quantum capabilities for ultra high precise calculations by 2040. Practically speaking, insurance has always been based upon risk pooling. And so the idea is, can we create more and more defined risk pools with much more discrete characteristics so we can price that risk better? Again, being able to do that is the essence of insurance itself. And so with these types of capabilities, we can now do that. Now, adding on to that, we have digital twin technology, in essence, creating a digital look-alike of a physical thing. And we see that as being incorporated into risk modeling to support complex underwriting. And so 50%, we believe, of all underwriting decisions will leverage digital twin technology in combination with AI by 2030. Of course, machine learning's been around for a while. And now what they're doing is integrating other data sources in real time to create things like real-time behavioral patterns, enhanced risk assessments and things. And then finally, we see future scenario simulations being modified in real time for things like, for example, threat prediction, and essentially enabling more proactive risk management as opposed to risk management after the fact.
2030, 2040, that's not far off for these advancements to be part of the mainstream, right? Because everything's being accelerated so fast. Something that's also being accelerated fast is fraud. So let's talk about fraud detection and cybersecurity. So financial fraud is a growing concern. And how is AI helping institutions detect and really prevent fraudulent activity in real time?
Well, AI is a bit of a double-edged sword. On the one hand, it is transforming financial crime risk management because you can move from reactive to predictive fraud prevention with real-time pattern matching. And these advanced fraud detection systems cut investigation time and also reduce false positives, which has always been the problem there, because it can look at multiple data points in a sophisticated way. And, frankly, almost everybody, all the financial institutions, insurers, banks, wealth management, et cetera, have invested in or are planning to invest in AI-powered fraud solutions. There are also machine learning models creating hybrid approaches, which are essentially combining pattern recognition with predictive scenarios. AI large language models are predictive or, not deterministic. So machine learning is more deterministic. So if we take probabilistic technologies like large language models, combine them with deterministic capabilities like machine learning, we get better fraud detection. The flip side, though, is unfortunately it's an arms race. The bad guys are also using AI. So we have adversarial AI. So as much as we can get better at detecting fraud, the bad guys are learning how to conduct fraud better as well. So it's a bit of a challenge.
I guess that brings up a question about some of those biggest security and ethical concerns when implementing an AI-driven fraud detection systems, because it's not as simple and easy as we think about.
Mm-hmm. Yeah, so this is a big bane of the financial services industry. 93% of financial institutions have expressed serious concerns about generative AI powered attacks on online banking. And 64% of fraud executives generally want to obviously leverage generative AI to detect and prevent fraud. So we have both sides. What are the challenges? Maintaining data privacy, preventing bias and discrimination, ensuring transparency and explainability, which regulators care a lot about, and establishing clear accountability frameworks for the outcomes of these things. So, we want to do this, but we want to do it right, and we want to do it ethically. So it's a question of doing it. And by the way, it's not an option because the regulators in banking and in fraud at the banking level, at federal and state, and of course state for the insurance carriers and others, they have to be accountable to regulators to do this stuff. So they can't choose to not do it. The other thing is that, there has to be a demonstration of compliance readiness and getting regulatory approvals for the things that they're doing. So the flip side is it may be a good idea. We may want to use it. It sounds great, but now how do we get the regulators on board with what we're trying to do? So that's the other side to this. So what are we saying generally? Balance between automation, human oversight. There has to be a human in the loop. It's a term we like to use all the time. There has to be clear audit trails, and there has to be intervention protocols as appropriate.
AI, generative AI, it continues to make waves, but talk to me in the insurance and financial services industry. How is it being used to personalize that customer interaction and really making it more about the human?
Mm-hmm. It's a great question. So, we're actually moving from a know your client to an understanding your client. It's not just knowing the surface stuff, but do we understand? And that means unprecedented levels of personalization and proactive service delivery, not reactive. So, on the insurer side, we see Gen AI-enabled chatbots and synthetic voice analysis for enhanced customer engagement. And many of the carriers we know and talk to have piloted these types of capabilities in 2024. We also see much more complex queries being handled by the chatbots, guiding customers through, the purchase process, guiding customers through the complexity of various products in a conversational way. Now, what's nice about these very modern chatbots is you can use AI to do a piece, and you can switch to a human to do another piece, and you can switch back to the AI seamlessly. And the individual actually doesn't know it's switching between machine and human being. By 2027, not that far in the future, 50%, we believe, of client meetings in insurance will be conducted virtually. 40% of advisors will be leveraging AI assistance during the interactions in real time.
And I have a couple follow-ups with that because chatbots and virtual assistants, powered by AI, they're everywhere now. Are we moving towards a fully automated customer service experience?
It's a good question. The answer is no. No matter how good the technology gets, there'll always be some human in the loop. Even by the year 2040, which is 15 years from now, we still think that the human advisors will remain essential for complex consultations. The simple ones, yes. Routine client queries, yes. But if it's complex, it's still going to ultimately fall into a human-to-human interaction. So where we see Gen AI playing, frankly, is enhanced first call resolution through real-time recommendations to service representatives while maintaining the human empathy in the customer interaction. If somebody, for example, reports a death claim because their spouse has died, you don't want to be mechanistic about it. You want to be empathetic to the individuals just lost somebody. So, the machines can't do that. That's why there has to be a mix, an enhanced capability, but not necessarily replace capability. The other thing is that we'll see, particularly for products like complex products on the life insurance side, universal products and other things, virtual meetings with interactive financial modeling for that individual taking place, with the AI handling the elements of the modeling. So we can see that as a complement, if you will, to the client interactions. And then the other bit here is these products require licensed people to interact. There's regulatory. So all things being equal, certain aspects of those interactions, particularly for products requiring licensed agents, that will still require human beings in the loop for that. And AI will essentially be a complementary tool as opposed to a replacement.
So I want to dive into regulations. So, but I'm putting you on the spot here first, Mitch. So AI is not going to come take our financial jobs.
No, I don't think so.
Okay. So let's talk regulations, and regulations around AI continue to evolve. What
Mhm.
compliance challenges should insurers and financial institutions be preparing for?
Yeah, it's a great question. So, firstly, insurance carriers have to demonstrate fairness and transparency of their AI processes to the regulators because AI, insurance is a regulated industry. And they have to also look at the challenge of the growth of large language models in the context of demonstrating fairness and transparency. The organizations also have to establish comprehensive, what we call model explainability and validation processes. There has to be clear lines of accountability. It can't be, oh, the model said so. Somebody has to own outcome. And it has to be clear to everybody who that owner is. Companies have to maintain human intervention and override processes in real time. They have to have appropriate audit trails to prove that they're complying with the regulations as appropriate. And there has to be transparency in AI driven decisions. If you choose not to insure someone and you've used AI to enhance that decision or complement that decision, you have to be able to explain why and what it did. And then, you're going to need guiding principles and governance frameworks for AI and strict policies around how to respond to the changing regulatory framework, because the regulatory framework is not fixed. It's evolving. And, in the United States, it's 57 different regulatory environments for insurers, including Guam and Puerto Rico and all these other places. So you have to have guiding principles. Otherwise, you can't respond and react appropriately from an AI perspective.
Bias is there in AI models. It's a major concern, right? So
Mhm.
how can companies ensure fairness and transparency when using AI-driven decision making?
It's a great question. And, to support the point, what we've seen with our research is that 62% of consumers place higher trust in companies whose AI interactions they perceive as ethical, making fairness crucial for business success. In other words, they're out there saying this to consumers right out of the gate. So, what are organizations doing? They're deploying machine learning observability platforms, essentially to monitor statistical changes in the data values that the AI models are generating and trigger alerts if the specific criteria around bias or fairness are not met. So, if it's more than 2 standard deviations, they see certain values, the machine learning will fire an alert, somebody get texted, you may have an intervention process at that point. But that type of observability platform is a critical component to achieving a non-biased outcome for the AIs. And then you have to have this process for human override decisions. But those things themselves, because humans could be biased as well, it's not just because it's the machine. You have to track that. You'll have to also correlate that, again, to changes in the algorithms outputs over time, because the problem with AI is large language models can hallucinate, which means they essentially can make up stuff to fill in the gaps where they don't know, because they're probabilistic, they're guessing as opposed to deterministic. And then they can drift. They can calculate stuff, and the math could start to be wrong over time, so they can drift. So we need to basically look at what's happening over time. We need to make sure that the outcomes are consistent with decision matrices, not just for the machines, but also to the human interventions themselves, to make sure the entire process, human and machine process, are working as designed. And then the models themselves have to maintain the transparency if they're operated by third parties. A lot of insurance carriers are using third-party partners for some of their AI. And so, you're kind of not off the hook. If you use a third party, you still have to do that. So there's going to have to be mechanisms in place for the clients to question and challenge AI decisions, irrespective of how those decisions and where those decisions took place.
One thing you mentioned there concerns me a bit, and I know it concerns a lot of people, is that drift that you mentioned. Because some of these AI models are building off of AI models that are building off of AI models. So the chance of error becomes greater. Is that a concern, do you feel, that we're not addressing as much?
Yeah, the analogy I like to use is a copy machine. if you make a copy of a copy of a copy of a copy, you'll notice the quality of the copy gets less and less crisp. It kind of looks a little blurry-ish. It gets hard to read. And that's essentially what happens with AI. So absolutely, there has to be a cross-checking on outcome so that because you can have AI-generated data feeding the AI again. And so you can get that copier effect that I described. And so if you start to drift beyond a statistical point from a guess perspective, because again, it's guessing, then you have to retrain the model to fix it and then re-release it. So the versioning, control of the model, and the quality of the model have to be deliberately managed and then recorded and then reported to the regulators as well.
A great example of that, it just popped in my head, is that movie Multiplicity with Michael Keaton. You
Right.
remember that, Mitch?
Yeah.
And each copy that he made of himself to make his life easier, it's kind of weird to think that's kind of the world we're in.
Right.
To make his life easier. The last one is dumb as a rock, right?
Right.
And it's so far from the original. So yeah. And never thought Multiplicity would come into Sweet Speak, but here it is. So let's look ahead. So what are the biggest AI opportunities and risks financial institutions should be thinking about in the next 3 to 5 years? Because some of those dates that you put out there aren't far off.
Mm-hmm. Yeah. So, I guess near term, now we'll say 2027, customer expectations are already moving. And we think that by 2027, customers will expect seamless cross-platform experiences. So that's the first thing, because, a lot of insurance carriers, for example, have different experiences depending on the different products and who's selling it to them. Is it direct? Is it through an agent, or is it through a broker? Are they going through an MGA, whatever? So seamless cross-platform experiences are the name of the game. And we also think that, particularly in the life side, AI-driven behavioral incentive programs will help with guiding people to the right types of products that are fit for purpose for their needs. Because, in the life space in particular, a lot of people are underinsured in the United States, but the products are complex, which it hinders the sale. So can we kind of guide people in this kind of consistent cross-platform experience to the right types of products? We're going to see definitely enterprise-wide use of large language models, and in some cases, small language models for some specialty carriers that have proprietary stuff that they don't want to train a large language model on, so they want to build their own models. But areas, underwriting, claims, policyholder assistance, and the organization is going to have to adapt. So what underwriting assistants do, what claims assistants do, how claims are adjudicated, how appetite is measured or pre-measured for the underwriter before the submission gets to the underwriter in the first place. Those kind of things will require organizational adaptation. We're just in the beginnings of those conversations now with the carriers. There's going to be a lot of what we'll call hyper-personalization. We think that by 2030, 2035, 80% of policy offerings will be tailored to individual profiles down to the lowest level of detail. In other words, we file product features as opposed to products, and then we could recombine the product features through the lowest level, almost like an atomic processing type thing, recombining it to the right product for the right individual, very hyper personalized to that person for all types of products. And on the commercial side, for businesses, so small business, small commercial, for example, and other areas that are specialized. So these hyper personalized types of offerings for risk coverage that are very, very, very specific. And again, advanced AI analytics will drive that, because you have to make sure you're pricing all that correctly. And then pricing becomes more and more complicated. And then finally, underlying all this is data. Data maturity is the name of the game. We're working with a lot of carriers in data maturity. I was out at London the other week talking to the UK carriers about that. We've just deployed a new data maturity model to measure the maturity of insurance carriers' data and data practices. So, data governance, integration, absolutely critical for next-gen analytics. It's the foundation, and robust frameworks have to be in place to fuel AI. The reality is, without good data practices and without data maturity, you can't reach these other goals. And so the carriers that don't do it are essentially become irrelevant over time, and they'll see their business drop off. They just won't be the place to go.
If you had to give just one piece of advice to executives looking to future-proof their AI strategy, what would that be?
Well, I would say, building on what I just said, success requires building a robust data governance framework, leveraging AI driven data quality tools, and ensuring collaboration between the people that matter, data engineers, data scientists, and the business teams themselves to get the data thing sorted out right. Data maturity has to be a focus. Secondly, organizations have to establish continuous, not after the fact, but continuous monitoring and auditing of data pipelines and AI models to ensure ongoing effectiveness and compliance. Is the data fit for purpose? Is the AI creating the right outcomes, all in real time, every time, 24/7? They're not there yet, but they have to do it. Strategic applications of large language models need to be developed for decisioning and action. So it's moving beyond what people have done today historically, which is more simple automation and workflow automation, to true intelligence, insight. And then finally, the carriers have to look at not just data quality, but really access and integrity of the processes and the data that's being utilized for the outcomes. And it has to be scalable, and it has to use things wherever possible that are, not impactful to the market as such, but a requirement for reliability and availability. So cloud-based data lakes, for example, next generation content services, platforms, and the like. So it's really creating a holistic deployment of all those things.
Finally, and thank you so much for the insights. Speaking of insights, what do you guys have going on at Datos?
Yeah, we have a big conference coming up at the end of April in Boston. We're focused a lot on data maturity because, frankly, a lot of insurance carriers kick the data problem to kick that can down the pike a little bit because they want to avoid things like, some of the data, master data management, some of the other expenses associated with data. But now that AI has become the thing, they can't avoid the data maturity challenge. So a lot of focus is on data maturity, getting that model out there, helping the carriers assess where they are and what they need to do. Another area, obviously, is AI, how to deploy large language models, how to avoid some of the things we talked about around discriminatory outcomes, but yet monitor this in a way that's effective, particularly in areas like underwriting, claims, and servicing. So those are the three areas. And we have a lot of we have speakers and some panels that will be in Boston covering some of those topics. And then really looking at the cyber element of this as well. And I know that I'm going to be on a panel with John Horn, who runs our cyber practice, on the adversarial AI and the impact to deploying AI and defending against AI in the context of what, increased digitization, essentially. So a lot going on. It's a very busy time, actually.
It's good to be busy. Good to be busy. Mitch, thank you so much for joining us today. Great to reconnect. It's been a minute since we talked, so thank you so much for being on the show.
Okay, thank you.
Thank you to Mitch for being on Sweet Speak. If you want to listen to past episodes of Sweet Speak, you can go to jamesdewayne.com. We have the podcast and the video versions of these interviews there. You can also buy the book Ringmaster of AI, Sweet Speak Conversations there. If you'd like to be a guest on Sweet Speak, reach out to me through the website, jamesdewayne.com. That's DWAYNE.com. Thanks for listening.